So let's start with our business bank account, a pot of money that we can use to purchase resources that we will use in the business. We can use funds from the bank account to buy material that we are going to work on to produce the products that we are going to sell. Alternatively, we can secure an account with our suppliers and acquire stock on credit, in which case our bank account will be unaffected, but we will have a liability to a supplier to the value of the material they have provided. We may need to work on these raw materials, but ultimately we end up with a product that we can then sell to our customers. Clearly, the object is to sell the items at a higher value than the cost to us to produce the product. In so doing, we have created value. We have generated a gross margin on the sale that flows into the business to increase our overall net worth. Our suppliers have now become our creditors, and our customers have now become our debtors. In the course of acquiring, producing and selling the goods, we will have incurred expenditure on salaries and on overhead expenses that will drain our financial resources and consequently deplete our bank balance. We cannot indefinitely continue to incur expenditure of this kind without inflow of funds to replenish our financial resources, and through the application of appropriate collection procedures, in due course we receive an inflow of funds as our debtors settle their accounts. And likewise our creditors will require settlement of our own outstanding debts with them. So we can now see quite graphically the dynamic nature of the business cycle. Material from our suppliers is converted to finished goods that is then sold on, generating an added gross margin, which is subsequently converted into cash upon settlement of bills by our debtors, thus increasing our liquid resources, which in turn is used to settle our own liabilities and fund expenditure on salaries and overhead. The greater the speed of circulation, the greater the amount of gross margin we generate, and the bigger our business grows. Let's introduce a level to the model now. We'll call it a waterline. And let's raise the waterline to the point that the positive assets of the business, that is the stock, debtors and bank, are above the waterline, and the negative drains, that is the salaries and overhead, and the negative liabilities, that's the creditors, are below the waterline. Now let's produce a list summarizing these assets and liabilities. The positive items we will show above the line, stocks, debtors and bank. The negative items, the liabilities, we will show below the line. If we total the value of all the items on the list, adding all the positive items above and deducting the negative items below, we arrive at the business net worth. This statement is the balance sheet. It is a snapshot in time and represents the value of all the assets available to the business compared with the value of all its liabilities. Now let's create another report. Let's add up all the gross margin inflowing into the business over a given period and put this figure above the line. Now let's total all the outflows by way of salaries and overheads in that same period and record it below the line. This statement is the profit and loss account. It covers a specified duration and summarizes all the inflows into the business and outflows from the business during that period. Now let's complete the model. As the business grows, it may require additional resources. It may need items of plant or equipment for production, it may need motor vehicles for transport, or it may need premises. Whatever resources that are necessary to support its operation over the long term. These fixed assets, as they are collectively termed, are funded from the liquid resources and consequently are an outflow from the bank. These fixed assets are of value to the business and will be used to support activity and growth in the future. As such, they appear above the waterline and will be itemized in the balance sheet. As the business cycle continues and its net worth grows, there may be a need to inject some additional funds to support expansion. These extra funds may be generated through borrowing, in which case there would be a positive inflow into the bank account which would be balanced by a corresponding liability to the value of the loan. This impacts the balance sheet with an increase in the bank balance by the amount of the borrowing that is countered with an increase in the liability by the value of the loan. And of course into the future the loan will be a source of a drain on the finance of the business as the loan is repaid over time and as interest on the loan is settled. So we have a picture of the finance flows in a business, showing how assets and borrowing through loan or creditors come together to generate value.